I am Matt Putra, CEO of 8X. We are a firm of fractional CFOs and finance professionals, and I'm your host of Conquering Complexity, Breaking Barriers to Sustainable Growth. Today, I'm joined by Diraj Goel. Diraj is the founder and managing partner of Get Fresh Ventures. They are a venture partner and catalyst, working closely with founders of high-potential startups to pursue hyper-growth. He helps them define and execute their purpose and vision through their go-to-market strategy. Diraj is based in Vancouver, British Columbia. Welcome, Diraj.
Thank you. Thank you for inviting me.
Yeah, I'm so excited to talk to you, man.
Welcome to Conquering Complexity, Breaking Barriers to Sustainable Growth, a podcast from 8X. If you're a CEO of a rapidly growing e-commerce and B2B CPG company, you're feeling the pressure of staying on top of increasing amounts of complexity. Our fractional CFOs help you regain control, streamline operations, and set the stage for sustainable growth. On this podcast, CEO Matt Putra and his guests share their insight on how to manage the complexity of running a rapidly growing consumer products company.
Welcome to Conquering Complexity, Breaking Barriers to Sustainable Growth, a podcast from 8X. Now, Diraj, one of the things I want to ask you about, of course, some people think finance is boring. I know that you don't. How has your financial management evolved from when you started to now? And in fact, I know you've had a very long career at fairly high levels. So feel free to talk about any part of your journey, whether it's your own business or when you're at those bigger companies.
Well, I think for finance, it started with my dad, who used to run a business in building computers for businesses, and that's how he paid the mortgage. And I was always really good with math or numbers, so he would always get me to go through and do his basic P&L and financial statements every month. It would sometimes literally be on the back of a napkin or an envelope. I saw numbers, I didn't see dollars, and that's a statement I've heard over time as well, because I was so focused on the numbers and optimizing it. It wasn't until I started to evolve from operations management as someone in technology, and even though I had the business experience, when I started to understand the alignment and the connection between what people did and how it translated the numbers. I came from an operations engineering mindset. So to me, a business is an operating system. And when I could start to make that connection from the dollars I had in the budget to where I needed to spend to what impact that would have on the business, and also how it could drive the right actions and behaviors, that's when it became that much clearer to me on how to look at numbers as dollars. Because most people in organizations have KPIs, but they don't really understand how that translates into dollars. And there's a key difference between those.
It's funny you say that because I have noticed that people, and especially in harder times since 2020, to now, like you look at your P&L and you go, wow, there's obviously some fat here, here, and here. Let's get rid of it. And then you get down into like what it is, like what are the people, what are the subscriptions, what are the tools? And at that point, people are reticent to let go. And what you're saying is you're understanding about, you can see the link between the dollars and the activity. So when you're looking at something that needs to be adjusted or fixed or turned around, how do you get from the P&L to like operational level changes that will drive profitability?
Well, so in everyone, working with founders, when they're trying to sell their solutions to a business, any kind of B2B startup, they think their competition is this other guy who's selling something similar that they are advertising and marketing. Their competition is actually inertia. People don't like change. They hate it. Like in history of time, change is something people have so much despair against, unless they're incentivized, they're motivated. They'll do all kinds of stuff to go on vacation, but ask them to change something on their regular day is anxiety inducing. So when you think about the cost sometimes is so mental, where you're like, okay, there's fat here. I need to switch something up, but oh, wait a second. If I disrupt this, then this stops working, and this stops working, and this part of the engine breaks. And if
Exactly.
this part of the engine breaks, then my products are not going to go out, and then my cash flow is not going to come in. So if I touch this,
Yes.
I'm kind of fucked.
Yeah.
So the fat's okay. It might be a little bit of grease in the engine, right? And inertia is the number one issue. People worry about the dysfunction of change. And sometimes the dysfunction is not technology or systems or operations related. but the predictability of what people are going to do and how that's going to translate into an output.
If it's okay, I want to ask more about this because it is true what you say when inevitably, and you and I both will go through a P&L and go, look, this has got to change and you got to reduce some fixed cost salaries, whatever it's going to be. And people always go, well, this is going to break and that's going to break. But is there an upside that you look at differently?
Well, I think the comfort is knowing that it is going to break and anticipating it's going to break and not being scared of it's going to break, right? You know, if you're always in fight or flight mode in running your business, you're already dealing with your list of things that are already broken that you're trying to fix anyways. The last thing you want is anything that you know works to break. It might not work. This is the mindset of 30% capacity is better than zero because I'm still hobbling by and it's a problem I'll deal with. So there's something to be said about if you're fight or flight, that problem is just not big enough for you to concern with. Like if you've got $100,000 deal at the table, and that's a $300 a month additional expense that you could live without, you'll just pay the $300 a month. So this is what I start to look at in terms of cascading priorities. You got 1,000 problems, you got time to fix three. Which do you fix? And use that urgency to then drive the change. But know that anytime you make a change to a human a situation, there's going to be fallout. The job isn't to avoid the fallout necessarily; it's to manage it in a way where you own the fallout, and in that process, you will avoid a bunch of different things that could cause more problems.
So in some ways, the word that comes to mind is a pre-mortem. Like, so before you do the change, you go, what are all the things? Why did all this fall apart after we did the change? But you're doing this before. And so then you're doing something like this and then preparing and making mitigation plans for the issues?
It's kind of like it's not actually mitigation plans for the issues because then now you're thinking about all the things that can go wrong, right? But Charlie Munger speaks about this, right? So what does optimal look like? And I always like to think in optimal fashion because with my ADHD, I'm lazy as F, right? Like I don't want to do something twice. It's like mentally exhausting for me. So I try to think about, well, what's the optimal going to look like? Okay, if optimal is to do this, to get to this point, what are the things that could go wrong and how do I avoid them? Right? So, like, for example, I was back at Vision Critical when we were scaling significantly. We had to do a full office move. And back then, your entire business infrastructure ran in your office. It wasn't a cloud. And so, if you move $100 million business, that's $100 million infrastructure for this global
What
company.
year are we in, real quick? What year are we in?
2020,
Okay,
I
got it.
guess,
Yep.
2011. Wow, that was a long time ago. And so we had to move this whole data center. And I said to the team essentially, look, is it possible for employees to leave one office and walk back into the other office, into their new assigned desk, have everything connected, they turn it up, and they get back to work like nothing changed?
I would imagine that's very difficult to do.
It is, but we pulled it off because what we had to do then was to think through what does that actually mean? What does that actually mean, right? Like, let's not be ignorant about it. Let's not be super enthusiastic about it. We knew certain things were inevitable, no matter how much change. Like, for example, people are going to still say that things are missing, something didn't work. So on the floor of the office, the main floor, we just set up a desk, put up a sign that says help desk, and people would just come up and ask for things, and there was buckets of extra resources, right? Like, so what were we going to avoid? Well, inevitably, people are going to have problems. What we're going to avoid is this massive help desk ticket
Oh,
waterfall,
I see.
right?
That
But
makes
there are
sense.
certain things that we couldn't avoid that we had to deal with, and then certain things that we could avoid. For the most part, people came in, and 95% of the people were great. So when you start to think about the changes that you're making, certain things are unavoidable, where you either decide that yeah, you're going to make the change anyways and accept those and then prepare for those. And then in other cases, you might decide it's not as big of a problem as it is until it is.
Cool. Yeah, that's awesome. I think that's something I deal with all the time. And when you finally get into the weeds, the people don't want to make the change, but at the numbers level, P&L level, they do. Okay, well, so another thing, as you know, businesses struggle with, and especially like Vision Critical, how big were they by the time you left there?
I think it was like 1,500 employees and about 150 million.
Yeah, crazy, right? So there's so much more data and systems and touch points and complexity in a business like that, and it grew from whatever it was to then. And I'm assuming at some point the infrastructure around understanding what was going on started to creak a little bit. Were you there during that? And then what did you do to help make sure people could understand what was actually happening?
So we didn't have cloud infrastructure when I started. That was like, late 2008, right? Salesforce had only just showed up like a couple of years before. So we were an early user of Salesforce. And my sales reports used to be these long form narrative reports where the sales team would be like, oh, we met these people here and everything. It was in an email, like in written in prose. And we're doing like, I don't know, 20 million in revenue, which is why I have a strong belief that most of the time people complain about the systems and processes, but generally it's because of the people.
That
It's
generally
not the
sounds true,
systems and
right?
processes, right? Because I built companies when we didn't have systems back in like 99. That was a contact management tool. There was no CRM. So if that visibility it's usually because things aren't going as planned because people are not motivated to the right outcomes. Because how do you build a $20 million company with no CRM and still be able to achieve targets and understand what the hell's going on?
No idea.
Obviously, something was working, right? Like it's not all of a sudden we woke up, there's all this technology, it's tracking everything and we don't know what's going on, so that's why it must be going sideways. It was always based on the individual group members understanding what success looked like and then being able to be accountable to everybody else on the protocol of that success. Google calls it OKRs. Is this kind of cascading a view of key results and objectives that sometimes are not a number space, but is that accountability in terms of what is their level of success to whoever they're delivering it to, right? So, when it became that piece, rather than look at it from the perspective of let's try to instrument everything, it was more so a root cause analysis of what is wrong and where do we need to look, and then unpack that piece. Sometimes KPIs would never be this thing that we put on a dashboard and looked at it all the time. Sometimes it was something we looked at only for a short period because we knew that part was broken,
Interesting.
right? But we could always reflect that part in one metric, right? We always have to find a new way of understanding whether there's value there. So, for example, if you're losing customers, churn tells you why. Okay, well, what's the next measure of explaining why? Well, let's ask the next question. We don't have that data. Why don't we have that data?
So yeah, I mean, you're honestly the third person to say this is like starting with the end in mind from the objective and then figuring out what do you need to know from there. I mean, and that works obviously in these small companies that some of them are smaller that we've talked to, 10 million. And I mean, it would have worked for you guys at 150, right?
Well, the thing is, the layered pieces become predictable, right? The more rote you have, like so. For example, when I first started, my team was 6 people. When I left, it was about 150, and we didn't have help desk tickets. People just email issues into the IT team, and they would just go run and deal with it. And then we became international, and I put some basic ticketing system. And then people started complaining about not getting support quick enough. So I started looking and seeing the response time. And then I got it to a point where I understood the economics of the help desk and what anomalies look like. So, for example, a new start is always going to have more tickets in the first 6 months, and then they'll taper out to some medium. We could see which departments were higher than norm, and then I had baselines. Only anomalies would get reported up to me at a senior level because that part of the engine was effectively operating within the margins of error. So I didn't need to manage it, and my team all had the right instrumentation to understand that they were achieving a quality volume of execution and avoidance.
Well, so you were talking a bit about like the data and alignment to strategy and escalations and stuff. So how as data proliferates, how do you make sure that what they're measuring is aligned with the strategy and that they're not measuring the wrong things or over-indexing on the wrong things?
So most companies will always invest in operations very, very late.
Yeah, yeah, yeah,
Uh,
yeah, yeah.
right? So, and when you build an engine organically, imagine you got this go-kart and you're just like slapping things on and building things up. But that go-kart is going to one day be an F1 vehicle, right? So now if you look at an F1 car, they're instrumenting everything. Everything is measured. Every part of the engine is being optimized. The driver's response is being optimized. Every single thing. At a certain point, you get to a situation where the technology advances or the engine starts to show its wear, and then you have to make a decision of what that re-engineering looks like. Person that's responsible for operations always there. You can start to set mandates about how you solve some of these problems. If it's taped on versus engineered on, there is at least someone whose focus is working on the business while everyone else is working in the business.
Yeah, I hired that too late. Yep. And now that we've hired it, we're off and running on a whole bunch of infrastructure and instrumentation, as you're saying. Yeah.
I have a team of three, and one of that person's role is operations,
You're kidding.
right? So yeah,
Man, I didn't do
um,
it till like 12.
and most of the stuff that we're operating on operates with predictability. And the way I determine predictability on what needs to be predictable is based on the urgency of focus. If some activity has innate urgency, like working with our founders, solving certain types of problems, then that piece needs to be well engineered,
Yeah. Right.
right? So I can press a button and it happens. So that engineering would take me time to focus on it, but I can put it in the hands of the operations person, and they would come up with a solution. We would review it real quick, and then have it implemented around a set of guiding principles.
And so sort of ask this, and you've sort of answered it, but to be specific, like, how do you make sure when people are looking at this data instrumentation that they're understanding what it's saying, like they're getting the true insight? They're not just, I don't know. You mean because I see some people that have a dashboard for this and a scorecard for this and an attribution tool for that, and they're still not making what I would consider to be optimal decisions. How do
Well,
you make
because
sure?
because they're not asking the right questions. Everyone thinks
Okay,
insights and
yeah.
data is the holy grail. It's kind of like you need to know where you're flying, how fast, and why you want to get there, and then figure out what's slowing you down. And then you ask questions about what's slowing you down, and the insights might be helpful for you to answer that question. But the insights themselves rarely trigger an activity, right? So, hey, our margin is low. Why? I don't know. Our cost of goods is pretty low. Is it shipping? I don't know. Let's look at shipping. Wait, we're spending 16% on shipping. What should it be? 9?
Mm-hmm.
Why is it this way?
Mm-hmm.
What's going on with it?
I see what you're saying. And
Right? So,
what would you have a mechanism that you like to use to surface the questions?
well,
Whether it's yeah.
so let's look at it hierarchically. I'm going to talk through assessing a company and then
Mhm.
assessing a sales funnel. Okay.
Sure.
So assessing a company, I look at it. Are you growing year over year? Yes. Are you doing it cash flow neutral? Yes. Good. What are your margins? What's your EBIT first? 1%. Okay. Well, what's your margins? Percent. Okay, so you're running your whole business on 30%. So I'm guessing you're like some kind of services company with some additional costs, right? Okay. So that's a pretty low margin. It should be higher, but let's figure out what's eating up into it. 70%. So, okay, this cost is high, this cost is high, this cost is high, this cost is high. Why are these costs high? Because it sounds like you should be spending lower and your margin should be higher. Because I can get a cost savings from top of funnel activity re-engineering because your cost of goods is your cost of sales. Right? So if you're spending too much on sales, let's look at there first. People rarely want to look at sales first and the cost of sales
Yeah, yeah, yeah.
because they try to squeeze the below the line. So the cost of
Hmm.
sales is your above the line, and then the cost of operations is below the line. You generally spend less on the cost of operations than you spend on the cost of sales because that is a direct attribution to revenue. So You go in there,
Right.
and generally those are optimized. You usually can knock out a significant percentage right out of your cost of sales, make it more efficient, and look for more opportunities. That then drives your top line, gives you more volume. Okay, then let's look at your cost of operations. What I end up finding is that they're spending too much money on one engine part or another part and just doing it inefficiently and not getting enough data and not spending enough on another area. So I usually see a greater reduction in terms of cost of sales than cost of operations. And then once we get into the cost of operations, the fairly rote stuff, most companies pay too much for that they should be outsourcing to someone like yourself and re-engineer and then have a whole bunch of headcount. And then they need to renegotiate some vendor relationships and contracts to squeeze out their costs because they haven't revisited that. But right there, I can start to see how you can optimize the business. If the business is losing money, it's always related to those elements. That's if a company is doing well. If a company is not doing well, it's still related to the same logic, except their unit economics is upside down. They're just spending way too much on sales, there's way too much on operations, way too much on something, and not generating enough on the monetization side.
And so, like, and then one of the things I know that you focus on is, and I'm probably not gonna, I'll let you say it the right way, but it's the where you find the people that want to do business with you the most efficient way possible,
Yeah,
right?
yeah.
Yeah.
The path of least resistance, right? Like the
Yes.
polar
Yes. Yeah.
strategy. And
And
that
yeah.
go ahead, sorry.
No, I was just gonna say, like, how is it that you begin to unpack that?
Well, it comes back down to that same optimal, right? You know, what is the least amount that I have to do to make this a win-win relationship for both sides? Because the other side doesn't want to do all the work either, right? Everyone just wants the transaction, the outcome. Unless the outcome is very human based and services based and experiential based, most people want most transactions to be very fluid. And that usually requires a conversation on what win looks like for the other side and how you can make that a meaningful relationship for both sides of the equation. Usually when you find that, you get the other side to be motivated. But to do that effectively, you need to understand what's an incentive for the other side, and that's meaningful as well. I operate under the consistent belief that people want to do the least amount of things to get the best outcome
It's
on
fair. Yeah.
every side. So if that's the case, then optimal fits within that realm. Does that answer
Yeah, I
a
think so.
question?
Yeah, I think
Yeah.
so. Yeah, it does. Yeah, and I for people who are listening, if you have a chance to ever talk to Diraj about this for your business, I recommend you do so because I'm continually impressed with the way he thinks and how fast you can get places with this. Like we're talking just generalizations, but like
Yeah.
as you know, I'm impressed by the way when you get into a business how fast you can figure some of that stuff out. So, I mean, again, here's a plug here, but fucking talk to Diraj about this stuff.
Thank
Um,
you.
it- of course, yeah, and I'll switch
Did
gears
you
just
want
a
me
little bit. Go ahead.
do you want me to cover kind of the root cause analysis of a sales target?
If you want to, that would be fantastic because I do love how you
Yeah.
think about this stuff. Yeah.
Well, so doesn't matter whether it's a B2B enterprise company or it's a SMB company or a B2C company, they all follow the fundamentals of funnel economics. First thing I always ask is, what's the target, right? So give me the target for the quarter. It's 1 million. Okay. Um, are we going to hit target? Yes or no? And that's usually the first wrong answer I get because most of the time, nobody knows.
Nobody fucking knows. No.
Nobody knows, right? Because to do that effectively, you need to do predictive math. And predictive math requires an understanding of current state as well as time sliced information to see trend analysis to then make a calculated decision on what that target needs to be. Now, if you look at B2B sales, a simple way to do it is a weighted average based on or a weighted assumption on the close stage of a deal and what percentage you've given to that stage based on a belief of stage level conversions.
Yep. Yep. Yep.
So something at the top of the funnel that you think is someone you've spoken to, and oh yeah, they sound like they would be a customer, and they probably would be on this $5,000 a month deal. So I think it's going to be $60,000, but we just started talking to them, so it's a 10% chance that we're going to close them. So I'll give it $6,000 versus the one, oh, that guy, it's $100,000, but we sent him a contract already and he was pretty good. And we've been seeing where when we send a contract, we pretty much always close it. So I'll count $90,000 out of that. You add that all up, and assuming that you have a close rate within a 30-day period, you can add all that up and
Hmm.
just peg your number. That's a
Hmm.
really simple way, right?
Hmm. Hmm.
So where in the funnel they are, what do you anticipate will close by the end of the month? And you can use smoke signals, you can use whatever you want to decide, or real data to make a judgment on that. And right, so that's a very simple way to calculate. You might be absolutely wrong because everything might close 60 days later, and not actually at the end of the month. But it's your best understanding of what's happening in all the people you're talking to in those relationships and what likely is closed. When you're wrong, that forces you to ask yourself, well, why was I wrong? I thought I was going
Yes.
to hit 100 grand when I added all this up. They all ended up closing later. Oh, this one I thought had a 10% chance of closing, actually had a 1% chance of closing. So then you start asking these questions, right? So
Hmm.
once you start understanding that there's a flaw in the engine, in your ability to predict, and you start asking why did you have a flaw in the ability to predict, that's when you start to drill in and say, oh, that deal I was wrong on, why was I wrong? That deal I was wrong on, why was I wrong?
Yeah. Yep. Yep. That makes sense. I mean, we so on the e-commerce and CPG side, like I like to specifically as D2C, like website sales, right? I like to build a map from eyeballs all the way to first purchases. And then we use cohort math for predictive on that. But once they're repeaters, but when you build it like the way you're saying, the very simple act of updating the month's like actualized numbers tells you what broke in reference to your projections. So that's why we like doing that. And in some ways, you can then also map out like ROI for investment at each stage of the funnel. So should I just buy more eyeballs or should I buy a better click-through rate? You can figure that out with like legitimate math. So that's
So,
something we're rolling
so
out.
if you think through it, right? Like in the natural graduation of a company, and again, this is optimal thinking. In the natural graduation of a company, your focus isn't revenue. Your focus is increasing the valuation of the company. That's shareholder thinking,
Yeah.
right? So first question you ask is, how would my company be valued? And most service-based companies, you're valued based on your growth rate and your EBITDA,
Mm-hmm.
how efficient you are in operating to generate profitability.
Mm-hmm.
And then how much you're growing shows the value by which it would take, or the velocity by which it would take for you to then pay back whatever's paid for by the company, whatever the company's worth is. So if the company is making $250,000 and you value the company for $1 million, it's going to take you 4 years. Now, if the company is growing 100% year over year and you only paid $1 million, you might pay it off in 2 years. But so that company would be worth way more. The way then you start to think about it is, I need to be able to predict this revenue so that I can drive that valuation. By predicting your revenue, your projections start to hold a lot more water. That helps with talking to banks, talking to investors, talking to external parties that you're partnering with, to invest the time into partnering with you. Whatever it is, the more predictable you are in your growth rate, the more confidence the market at large will have in your ability to lead a successful venture, that they'll put money down. So the economic thinking of knowing where your revenue is going to go based on the activities that you're doing is essential in building a high value company.
Yeah. So just doing it like forecasting with some realm of accuracy adds value, is what you're saying.
Exactly. And you don't need to be 100% perfect because even the big companies have a challenge because
No.
there's more complexity. If you can do it back of the napkin and get it right to a small degree of margin of error, and you can't do it off the back of the napkin, there's a reason why, and that's the problem you should fix.
Well, before we take a break, I want to ask you if a magic genie were to appear and grant you one wish you could use on the financial side of your business, what would you wish for?
I would want to be able to set a EBITDA target, and then the system to tell me based on my activities to date what to turn up, what to turn down, and what the measures of the derivative measures are to get to that EBITDA number.
And like, yeah, that would, could you imagine? Could you imagine? You just knew what would work. Oh my gosh. Okay, great. Well, with that, we're gonna take a quick break, and when we come back, we're gonna learn a little bit about Diraj.
You've spent over 20 years in corporate, and now you've stepped off the hamster wheel to run your own show as a fractional executive. Whether you're flying solo, leading a small firm, or running a boutique, Maven is your fast track to earning over $500,000 annually, and potentially more, without the grueling corporate hours. This is your shot at the freedom, flexibility, and independence you've worked so hard to achieve. By infusing your intellectual property into all aspects of your revenue generation, Maven transcends the limitations of other sales and marketing approaches. You'll have a pipeline so full that prospects who truly value what you bring to the table will be the ones knocking on your door. You'll work directly with Jay and Taz, who've led the way for over 30 years, helping countless executives make this leap. Contact j.kingley at fractionalmaven.com. Spots are limited, so act now to build the business and life you deserve.
Welcome back, everybody. We're talking to Diraj, founder of Get Fresh. Diraj, I want to find out a little bit more about you. What happened in your life that most explains where you are today?
My wife got pregnant, and as we had been trying for a few years, I actually was very much a workaholic and kept pushing off the date of when we would have kids. I was 5 months to 40 when I had my first child, and 3 months before her birth, I quit my day job. And when you work in operations, especially when you're working at a high growth startup that's scaling and growing, you're absolutely right in the complexity in a business. There's always a new problem. There's always a challenge. My Mondays would be high stress. My Fridays, hopefully, I'm having a few drinks because I owned and dominated the week. Some weeks were good, some weeks were bad, but every week I was in it for 70, 80 hour weeks. I was obsessively focused on growing. I loved it. I enjoyed every minute of it. I didn't complain one bit. But it gave me a lot of anxiety thinking about what that would look like with a child. And that's why I do what I do today, because my entire goal when I was building these companies and spending those hours and weeks in that high focus, high productivity state was to grow as quickly and lean as possible.
Yeah.
And I had to do that because we were growing companies with limited capital.
Yeah.
I had the unlucky experience of growing during downturns where
Mm,
capital wasn't easy, but we had rabid demand, and it was ours to leave on the table, but we didn't have money. We were only dependent on our cash flow.
mm,
But that was, not looking at it from the point of exuberance and, what we saw in the late 2000s and right up into 2021, where junior guys were getting paid $250,000 and people were just throwing money at every kind of problem. So when I saw what I saw with a lot of founders outside of the ones that know how to raise capital right, is that they struggle with that. How do you actually get output and outcome when you have very little?
yeah, yeah, yeah.
And I knew how to do that. I know how to do that very well. And that's where I had to rethink. If I'm not working in these states and working in these companies as a full-time employee, there was no such thing as work from home. There was no such thing
Yeah,
as
right.
wellness days. There were none of those things. You're working 52 weeks of the year, even on Christmas, right? And I did not want to have that experience. So now I work with founders so they don't need to have that experience and can build and scale companies more effectively with technology.
Amazing. Who is somebody you look up to, or if you have a hero, who would that be?
I think, I don't, the challenge with heroes I find is that the older you get, those heroes start to turn to villains. As like Elon Musk and so on. Every vaulted person that you put ends up being someone who lets you down. The one person who's always been my hero is my dad, and he was flawed, but he was authentic and he cared. And I think for me, whenever I see that type of genuine care and interest, and willingness to support the other person, That's the type of genuine person I look up to. And those are a few and far between, unfortunately. Yourself as one of those, right? You know, there are lots of folks that are there to sell you something, and there's nothing wrong with that. Everyone should sell. But there is a certain group of people who are fiercely genuine about helping.
Yeah, and I would say you're one of those too. And you know Antonio Ivanovic, right? Yeah, he's one of those guys for me. I think I mean, I know this is about you, but anyway, but when I was trying to break into a white collar job from blue collar, he was the very first person that started inviting me to events and meeting HR professionals and all these things. And in no small part, I was able to get office job. Yeah, because of his help. Yeah,
He is a genuine heart. He
100%.
never asks for anything.
Yeah, it's crazy.
He always gives, always intros. He's a good human.
I,
He makes being a good human look easy.
I'm gonna send this to him. Awesome. So, okay, now what is the best way for people to reach you if they want to?
The best is actually message me on LinkedIn or email me. It's just Diraj at getfreshventures.com. I've got someone who looks at my email even if I miss it, and you will get a response.
Well, thank you so much. And we will put that in the show notes, of course. So I want to thank you so much, dude. This was awesome. Yeah, I mean, I was very excited to have this call, and thank you for making some time. For the listener, please be sure to subscribe to our podcasts. We're on YouTube, Spotify, I think all the major ones. And remember, guys, growth isn't just about scaling up. It's about keeping things simple so you can grow without your hair falling out and be profitable. So conquer complexity, break through the barriers, and take one step at a time towards sustainable success.